So there's a type of arbitrage called put-call-parity arbitrage. This is really exploiting the incorrect pricing of options, or we could say a bit like there's a mistake in the market where the future value of something ends up being more than what it's priced at today, meaning that we can lock in that profit. Now, this is something I'm investigating very seriously. I'm looking at the Quedex platform, Deribit, and some other platforms in the derivatives market in crypto to try and find some arbitrage opportunities that are likely hiding under some stones. But before I do that, what I wanted to do in this video is explain put-call parity so that you can get an understanding of what this type of arbitrage really is. And it's also a really cool way to demonstrate to you what options are and how they work. And I know I've covered a lot about options on this channel. There are playlists on that, but I think this is an area that is seriously overlooked, and I'm looking forward to taking you through it now. So what is put-call parity? Well, the best way to explain that is to show you a call option and a put option and talk about what happens when we trade those in a specific way, or what should happen with the price and what doesn't always happen with the price, which is what presents an arbitrage opportunity for us. So the first thing I want to look at over here is I want to look at a call option. So I'm going to go here and set a position. I'm going to buy a call option. Bitcoin's price right now is about $8,200. So I'm going to punch that in there. The expiration date I'm going to put in here as 2019, December the 28th. It doesn't really matter what date, etc. I put it in here. It's just for illustration purposes. Bitcoin's volatility right now is at about 70%. And we want to look at the payoff chart at expiration. Now, don't worry, if you don't know what an option is or what I'm doing over here, don't worry about it, because I'm going to talk a bit about that at the end of this video. But a lot of folk who follow this channel already know this stuff. So I'll save that till the end. And if you don't know what this is, watch the end. You can watch the video again. It's all going to make sense. It's going to blow your mind. It's amazing. In fact, the first video I ever did on this channel was talking about Bitcoin options. So let's go into that. So I'm going to add this position. And now I'm going to exit. So when I look at this, I can see I've got my payoff chart over here, which is really interesting because over here is the underlying price of Bitcoin. So if Bitcoin lands at $9,200 as at this expiration date in December, I basically make profit, or I'm at the money. I'm essentially able to, any price increase from there is where I make money, and I make no loss at about $9,200. But if the price is below that amount at expiration, so on the 28th of December, I lose a fixed amount of money. So the cool thing about a call option is if Bitcoin's price goes up, my gain is unlimited. But if the price goes down, my loss is fixed. It's limited. So it's a really cool way to actually trade Bitcoin with actually limiting your loss, and it can be used for hedging, etc., the other way around, which we can talk about again in other videos. But for here, just understand that if price goes up or it ends higher than its price today, which is 8,200, so if it ends up at 9,200 or greater, as at the December the 28th, I make money. And by the way, I can sell an option, I can get out of my position earlier than that date if I want to lock in profit. So let's say the price goes right up and I want to get out and then it goes down, I can do that. So options actually buy us time to let the market do its thing without having to lose sleep overnight. So this is super cool, but this is essentially what a call option payoff would look like. Now, let's get to a put option. So I'm going to enter a new tab over here and I'm going to set a position. I'm going to I'm going to sell a put option. I'm going to talk about what that means in a second. So let's say $8,200 is the price of Bitcoin. Let's say the exercise price is at the money, so $8,200. And again, 2019 December, the 28th is going to be the expiration date. I don't even know if that's a real expiration date. I'm kind of just making that up because I haven't checked. But the volatility as well, I'm going to say is 70% to keep this a like-for-like scenario. And I'm going to add position. So now let's look at the payoff chart for this. So what am I doing here? So I'm selling a put option. A put option means, so let's say you buy a put option. Put option means you make money as the price of Bitcoin goes down, but if the price of Bitcoin goes up, your loss is fixed. So if we looked at the call option and reversed it, then what you would see is that as the price of Bitcoin goes down, you're actually going to make money. So your profit would go up, the stripe would go this way. And then if the price of Bitcoin goes up, you would lose a fixed amount of money. So it's the opposite of a call option. But now you can not just buy a put option, but you can sell a put option. And when you sell a put option, it inverts that payoff chart, meaning that if the price of Bitcoin goes up, I make a fixed amount of money, but I lock that money in today. So essentially, I'm selling that option. So it's like selling a product. I'm getting paid for that product now. But if the price moves against me, then I lose money. Now, if we look at this option here, the put option that we're selling and the payoff of that, and we look at the payoff of the call option that we're buying, and we look for an arbitrage opportunity here, we might actually be able to go and find one. So for example, let's go over here to a combined chart. This is where I'm now going to add the two together. We're going to buy two positions. So we're going to start again. We're going to buy a call option at $8,200 with an exercise price at $8,200, and 2019, again, December the 28th, volatility of 70%. So I'm just putting in exactly the same positions, but now I'm going to combine it with also buying a put option. So position 2, I'm going to sell, a put option. So I'm actually going to sell that put option to someone else who's going to buy it. $8,200, exactly the same positions, add position. Now look at what happens over here. We can see our payoff chart is essentially neutral. So at $8,200, if the price goes up, I make money. If it goes down, I lose money. So that's just like owning Bitcoin or buying a futures contract. So essentially what we're saying here, and I'm going to use my pen tool over here to draw some very basic math on the screen. What we're saying here is that if I go long a call option and if I short or sell a put option, that should be equal to a futures contract. Now here's where it gets interesting. Let's say, for example, it doesn't. So now let's essentially say that the prices are mispriced in the market. You see, with this input information, theoretically a put price should be $1,046 and a call price should be $1,141. That's what I should pay for these options, for the right to buy or sell that asset at a predetermined price at a predetermined date. That's what I should pay for it. But now I'm selling the put option. So I get that money in instantly as income. So what if that's mispriced? Let's say that's $1,300. And let's say the call price is actually underpriced at $1,000. Well, I can just punch that in theoretically and show you that with an $8,200 strike price, you can see that there's a small gap here where even below $8,200, I make money. And essentially that is where the arbitrage opportunity occurs. So I'm going to go more into this. I'm still working through the mechanics of exactly how this would be traded myself between multiple exchanges, etc. But I wanted to at least demonstrate in principle what put-call parity is by taking a call option plus a put option, combining it together to give you essentially a futures contract so that you understand the maths of what should happen here in the world of put-call parity. So for those of you who are not sure what an options contract actually is, I'm going to explain that right now. For those of you who know, you can leave the video right here. But for those of you who want a quick crash course, you don't want to go through the whole playlist that I've created on this, which I'd encourage you to do anyway. But if you don't want to do that, then this is going to be really useful for you. So we're not going to talk about Bitcoin or stocks or anything like that right now. I'm going to talk about houses. Let's say that I own a house in a volatile market that you're interested in, but both of us are uncertain about this market and how house prices might change. They might go up a lot or they might go down a lot. And you're very interested in my house, so you knock on the door and you say, hey Sean, I'm interested in your house. Would you be interested in locking in a price, but I can only pay that price in the future? And I say, okay, cool. When can you pay it? You say March next year. I think, okay, that sounds quite interesting. What price should we lock it in at? And so what we do is we agree to enter into a contract. So with this contract, I'm going to agree to allow you to have the right, and not the obligation, but just the right to buy my house in the future at a predetermined price, at a predetermined date. So this is very advantageous to both of us because for me, it means I can lock in this idea that if the house prices go down, I can actually protect it because the value of the contract itself protects me from that loss. You can see how this could be very useful if you're a Bitcoin miner, for example, to protect yourself on the decline of Bitcoin. If prices could go down, you can actually use an options contract, just like with this house example. but let's stick with the house. So for example, you agree to buy a call option from me. And let's say today my house is worth 100,000. I'm just going to keep the numbers easy. And you just want to lock it in at, I don't know, let's just keep it at 100,000. You could lock in the price at 110 if you want to and pay me more for that right. That would actually be embedded in the calculation, but I'm going to keep it simple for now. And you tell me that by March the 28th, you want this contract to live for. You want the contract to live from today up until March the 28th. We're on the 4th of October 2019 right now when recording this video. And house price volatility, we're in a crazy area. It's like 20%. So this is why we want to do this contract. And we decide to enter into this contract. And so this is what happens. This is what it will look like on a payoff chart. Now this payoff chart looks at what the value of this option will be at expiration. So how much money you can make or lose just from this contract, and you can trade just the piece of paper because it's worth money. It's a legally binding contract that gives me the right, or gives you the right, to buy my house at a certain price by a certain date in the future, or at a certain date in the future. And so at a European style option, it's at the certain date in the future. An American style option, you would be able to exercise it any time between now and that date in the future. So there's two different types of options. We usually deal in European style options. So this is what it looks like. So if the house price goes up over $105,000, you've actually broken even, because the increase in the house price has actually covered the cost of your option. And the cost of your option to be able to lock in prices with me cost you $6,700. So you had to pay me $6,700 today. So if I sell you a call contract, that's what you'd have to pay me today for my house. Now, if the house price stays at $100,000, you've lost the $6,700, which was the cost of your insurance. If you think about a call option, it's just insurance. You can buy an insurance for Bitcoin. And again, the first video done on this channel was about that. Buying options is like buying insurance against your Bitcoin or your house or your stocks or whatever. So that's essentially what's going on over here. Now, one of the things I can do with this date is I can change the date. Let's say we are actually in, I don't know, the 5th of December 2019. This chart will actually change the curve. It will show me the value of that option at that particular date. So let's say house prices do swing a lot. They swing up to 105,000, and you've actually now made a profit, and we're in December, so we're not even at March yet where the contract expires. You could actually now sell that contract, that option, and lock in a profit and not have to buy my house at all. And in fact, you never had to buy my house, because with an option, you don't have an obligation to buy the house. You just have the option to do it. That's where it's very different from a futures contract, by the way. So you can actually lock in that profit just by trading the contract, which is why earlier when we did the put-call parity, if you can see a discrepancy in the price, you can lock that money in today. So I hope you found that interesting. See you in the next video.